All right, welcome to Columbia University Weatherhead Institute of East Asians event, Financial Cold War. We are extremely happy to have Mr. James Falk, the author of a new book, Financial Cold War, with us today. Mr. Falk is a veteran financial and strategic advisor to corporations and governments around the world. He was a senior executive at the Hong Kong Exchanges and Clearing, including the position of chief of a staff first, and then head of a strategy, member of the executive committee. And this was during the time when China was rapidly internationalizing, both in financial sector as well as its economy overall. And prior to Mr. Falk's appointment in Hong Kong Stock Exchange, he worked as an investment banker, including, if I understand correctly, Citigroup's head of strategy, specializing in various aspects of financial services. He just released this book, Financial Cold War. So we're very happy to have him here. So welcome to Columbia.
Thank you very much. And
let me turn to James to give us first a summary of the book, and then we're going to have a Q&A session, please.
Thank you, Shang-Jin. I'm just going to share some slides on the screen here. I'm very grateful for this opportunity to speak to you all, and thank you everyone for giving of their time to come listen to this. In 2013, I found myself sitting in heated discussion with my opposite number at the Shanghai Stock Exchange, a gentleman by the name of Fu Hao. At the time, we were in the process of working through the implementation details of what ultimately became the Shanghai-Hong Kong Stock Connect link. This is the link that allows international investors through Hong Kong and mainland investors through Shanghai to invest in each other's markets. And it was a landmark financial opening or capital markets internationalization program for China. Since its launch, trillions of dollars of flow have taken place or been channeled through this channel. But the reason why we were in heated discussion was because there was a point of disagreement. And I have to admit, getting quite frustrated because what I was pushing for was standard international practice. And I just simply could not understand why Fu Hao, a very sensible gentleman, disagreed. And I thought that he simply didn't understand. Fu Hao turned to me and he said, why do you think we should do it your way? I said, this is standard international practice. And then he turned to me and he asked me, but why? And it suddenly dawned on me that it wasn't that he didn't understand what the international market practice was. It was that he had looked at it and he disagreed with it. And to my shame, I couldn't explain why it was the way it was. It just was that way. I'd never really thought very hard about it. And I just thought that we should do it that way because that's the way it was done everywhere else in the world. I certainly didn't have a good understanding of the practice in the mainland Chinese market. But I tell you this story because I believe that a lot of the conflict today that exists between China and America arises out of a failure to try and understand things from each other's perspectives. I since then went on a huge journey of trying to better understand why the structure of the international markets are the way they are and why the structure of the Chinese markets are the way they are. And that has significantly helped me in my thinking about why America does things in a certain way, China does things in a certain way, and why some of those different ways of doing things can lead to conflict between them. Recently, we've seen a great tragedy unfolding in the Ukraine. I think this provides us a stark reminder of the horrific dangers of mismanaging geopolitical conflicts and allowing them to get out of hand. The reason why I wrote this book, Financial Cold War, was because I believe that we must all try and better understand where each other are coming from and what are the structural problems in the global financial markets that are contributing to tensions and conflicts between China and America. So today I'm going to talk broadly about three subjects. So first, what are the fundamental purposes of financial markets? Second, how have they contributed to US-China tensions? And then thirdly, how can we reform financial markets to help de-escalate US-China tensions? Many people look at financial markets as a place for bright young people, probably many of the people in this audience, to go and make avaricious amounts of money working in hedge funds or investment banks. But that actually wasn't the reason why financial markets were created. The two fundamental purposes for which financial markets were invented and exist are, firstly, to provide a mechanism for society's resources to be allocated. And secondly, to provide a means of sharing risks such that people can accomplish together much more than any individual or small group of individuals can accomplish alone. And by fulfilling these two functions, financial markets have contributed immeasurably to human civilization and development. But ultimately, financial markets exist within institutional frameworks of rules and regulations. And when those rules and regulations drive the wrong sorts of incentives, they can lead to horrific imbalances, which can have significant social and political repercussions. So what is the financial Cold War? When I use this phrase, most people's minds immediately jump to trade wars, financial sanctions, and so forth. By the time you get to that point, you're already in a financial hot war in my book. What I mean when I say financial Cold War is, as I define it in the book, at its most fundamental level, it is the invisible conflict embedded in national financial policies and the structure of international markets over the distribution of wealth. Financial cycles and historical cycles overlap very significantly. The chart on the left-hand side of this page shows effectively the distribution of income within the United States over roughly the last 100 years. The blue line shows the share of income taken by the top 1%. The red line shows the share of income taken by the bottom 50%. As you'll see in the early 1900s, the era known as the Belle Epoque, or probably better known here in the United States as the era of the robber barons, there was huge wealth and income inequality. And during that period of time, 2 world wars were fought. These were not a coincidence. Wealth and income disparities led to huge social tensions. And what happened was, in some countries, this led to overturns of the existing regime, sometimes in very violent fashion. And that opened up a series of experiments in communism, which took place through the 20th century. Even countries that did not go through that violent transition tended to better redistribute wealth through the 1950s, 60s, and 70s, generally through industrial policies which drove greater egalitarianism, through fiscal policies, higher taxes on the wealthy, more redistribution, and through investment in education to give better access to opportunity and greater social mobility. By the 1980s, it became apparent that communism wasn't working, simply because although communism's aims are very admirable in wanting to achieve more egalitarian societies, the reality is that what was shown was that by issuing the mechanisms of markets and the incentives that those create, people didn't have incentives to work hard, and they didn't produce, and they didn't drive economic growth and productivity. And ultimately, the populations under those regimes, quality of life suffered. From the 1980s onwards, we saw a great reversal towards free market policies. And these were very, very successful in driving a high level of economic growth. But what you've seen is, as you see on the right-hand side of the chart, you've seen wealth and income inequality opening up again very significantly. And a big theme of my book is that it is fundamentally the rise in wealth and income inequality and the domestic social tensions that those are creating in both China and America that lie significantly at the root of the growing tensions between the two countries. So the key battlefronts in this financial Cold War are, I would say, four things. First is the US dollar's role in the international monetary system. Second, international tax competition between countries. Third, industrial policies, and particularly failures in antitrust policy and enforcement. And then fourthly, in perverse incentive structures that exist in both the public sphere and in private enterprise. Many of you will know the history of how the dollar came to come into this international role. It originates in an agreement that was signed at the Bretton Woods Conference in 1944 at the end of the Second World War, when the US was the dominant economy in the world, accounting for roughly half of global GDP. This system lodged the US dollar at the center of the global monetary system. And by that, what I mean is that it became the reference currency to which all other currencies were fixed. And in turn, the US dollar was fixed to gold. And although President Nixon took the dollar off the gold standard in the early 1970s, this system has stuck with us. The problem of the US dollar system, though, is that, and this was not fully appreciated at the time of Bretton Woods, but became very apparent in about the decade or two after it, was that in order to serve in this global utility role and support the growth of international trade and investment, the US had to constantly keep supplying more dollars to the rest of the world. In other words, it had to run a balance of payments deficit. And this was all well and good while the US economy was growing at least as fast as the rest of the world. But for a long time now, the US has been a large, mature economy, and other countries have been growing a lot faster. What this has led to is the US having to go into higher levels of debt in order to support the dollar's global utility role. This has created a fundamental fragility at the heart of the US financial system. And because of the US financial system's centrality in the global financial system, it has created a fundamental fragility at the center of the global financial system. And this is why we're seeing a greater frequency and greater violence of financial crises and shocks in recent decades. The other issue with the dollar serving in this role was that it created a demand for the dollar that, through its role in international trade investment, that caused an structural overvaluation of the dollar. So the dollar wasn't able to adjust to reflect new economic realities. How this has fallen on Americans really depends on where they sit in society. So if over the last 40 years you've been the wealthy shareholder of a large US corporation that's been able to take advantage of this phenomenon and outsource your production to lower cost centers with undervalued currencies, you've generally done very well. The companies have lowered their costs, increased their profit margins, and you've seen your share price go up. If, on the other hand, you have been a US manufacturing worker over this period of time, the picture hasn't been so rosy. Your story has been one of displacement, job loss, at best, long-term wage stagnation, contributing to a rise in social inequality. Fiscal policies. So, as the world has globalized, all countries have wanted to attract investment to themselves. And one of the key means through which they've done that is through offering tax incentives, or at least lower rates of taxation. If you recall that capital is far more mobile than labor. You can move money at the touch of a computer key, whereas if you want to move yourself, it's very difficult. You've got to sell your house, you've got to move to a new country, find a new job, find a new house, maybe find a new school for your kids. People don't do it as much. And so the temptation for governments has been to try and tax capital at lower rates than labor earnings. What this has resulted in is incredibly balmy tax systems in which the very wealthy, whose income derives far more from capital income than from labor, have paid or end up paying far lower rates of taxation than average middle class workers, again exacerbating or contributing to the rise in inequality. The United States is the home of antitrust. The term antitrust actually arose out of the trust busting of the Standard Oil Trust by Teddy Roosevelt back in the early 1900s. This need for, or all capitalist systems rely on competition as a major driver of their efficiency. We're all familiar with the fact that monopoly or oligopoly companies can tend to charge higher prices to their consumers, but they can also do other things. So monopoly companies or oligopoly companies tend to be able to control wage rates across their sector. They also, in absence of competition, have less incentive to invest in research, development, product development, and other productivity growth. And in aggregate, a highly monopolized or oligopolized society tends to stagnate and see longer or less long-term economic growth and productivity. This should be very worrying to us. Over the last couple of decades, 2/3 of US industries have consolidated down into the top 1, 2, or 3 players, as you can perhaps surmise from the chart of M&A deal volumes on the left-hand side of the page. But yet the US administrations have not really stepped in to trust bust. The last trust busting exercise that the US have pursued was the AT&T breakup in the early 1980s. The second Bush administration pursued absolutely no breakups of any monopoly or oligopoly structures, and in fact didn't block a single merger or acquisition in the United States on the basis of anti-competitiveness arising from those deals. Why haven't they done this? Well, a lot of the problem has come down to perverse incentives that exist in public life. If you look at the US electoral system, a huge amount of money slotted around in it, and the fact is that many politicians ultimately depend on wealthy donors or corporations that contribute to their campaigns. On top of that, you've had a huge revolving door between public life and private enterprise, which serves as a disincentive perhaps to some people regulating industries or setting the rules from coming down too hard on companies for which they might work at some later stage in their career. But it's not only public sector incentives that are the problem. In the private sphere, what we've seen is a huge rise in share-based competition. I can tell you from my experience working in a corporate or in business, is that if your incentive structure is for the share price to go up, it's a lot easier to drive share price upward movement through share buybacks than to invest in the hard yards of research and development, product development, and general organic business growth. What you've got here is that people with their hands on the levers of the economy don't have incentive to invest in long-term economic growth. And this is contributing to the stagnation in productivity growth and the stagnation in the economy. So we've talked a lot about phenomena which will be very familiar in America, but how about China? China over the last 40 years has experienced rapid economic growth. It has very successfully raised hundreds of millions of people out from abject poverty into the middle class. It has been a story of massive success. But China faces a number of significant challenges today. These four major challenges, I would say, are its rapidly aging population, a continued reliance on a top-down investment-led economic growth model, failure to develop its domestic capital markets, and lastly, or recently, the rising geopolitical conflict with the United States. The Chinese economic miracle owes itself in large part to a huge demographic dividend. When Deng Xiaoping began the process of reform and opening up in 1978, it coincided with a huge number of baby boomers coming into the working population. On top of this, you had a huge number of people who'd been economically or politically marginalized during the Cultural Revolution, returning from the countryside into the cities and rejoining the workforce. And in the late 1970s, you also had the one-child policy being put in place, which dramatically reduced the number of dependents per working age population. And the Chinese government, rather than following the path beaten by many emerging markets countries, which is to borrow heavily from international markets for their development, the Chinese government issued in large part a lot of foreign borrowing and instead relied on the savings of its people. And the way that it did this was that it, through the government's control of the state-owned banking sector, harnessed Chinese savers' savings in order to invest in infrastructure development and other government priorities. This is what helped create the infrastructure of roads, railways, ports, and so forth, which so powerfully drove China's export growth model from the 1990s onwards. This, of course, required that the government pursue policies which held down consumption. And still to this day, Chinese consumers consume a far lower proportion of their GDP versus other comparable countries. The problem today, though, is that China's population, China's working age population, has already been declining for a couple of years now, and the overall population is projected to decline quite significantly over the next couple of decades. This will inevitably create significant tensions for the Chinese market, not least because from having today roughly 7 working age population to support each dependent, by 2050 it's expected that China will have just over two working age population to support each dependent. This is going to be a very heavy social burden indeed. It will require the government to dip into its pocket very significantly and put significant stresses on the government finances. And anyone with any understanding of what's happened in Japan over the last 30 years will also understand that this could well lead to significant asset price inflation. Think about all that property, residential property, that's been built, which has been put into the savings portfolios of Chinese households, which aren't going to have anyone to live in them in several decades' time. This is a big problem because of China's top-down investment-led growth policy, it has singularly failed to develop its domestic capital markets. And so the capital markets are nowhere near as mature as the country's status as the second largest economy in the world would perhaps suggest. The price discovery mechanism of China's markets has largely been removed because the state has tended to allocate to its preferred projects, and it has tended to offer favorable costs of capital to its preferred projects. And China's markets have really not had a significant role in pricing and allocating capital. Many Chinese view the Chinese equity markets as a sort of casino. And so most of them have ended up investing their savings in real estate. This is the main savings vehicle for, or this is where 78% of Chinese urban household wealth is invested. That compares to around 35% in the United States. The second largest store of China's savings is in cash deposits at banks. As of the end of 2021, that figure stood at 35 trillion US dollars, which vastly exceeds the size of China's equity and debt markets. If you think about the needs of Chinese retirees, given the aging population and the need to defray the government's social welfare spending burden, there is a huge need for those cash deposits to find their way into capital markets to generate better returns in order to support those Chinese savers through what will hopefully be a long and healthy retirement. Pause there for a minute. The other issue facing China is that when Deng Xiaoping said that some people ought to go out and get rich first, that was a very successful way of helping unleash China's entrepreneurial spirit and helping to drive economic growth. But what you've seen, in a very rapid space of time is a huge rise in wealth and income inequality. The blue line on the left-hand side chart on this page shows the share of wealth, share of China's wealth, which is owned by the top 1%. The red line shows the share of wealth held by the bottom 50%. In a very rapid space of time, China has actually gone to a level of wealth and income inequality that actually even exceeds the United States. Although this is not yet a hugely acute political issue in China, because most people over the last 40 years have experienced only significant improvements in their lifestyles, the fact is that given the demographic cliff that the country faces and an economic model which I think will struggle to continue to power strong economic growth in its current setup, this could well lead to significant social tensions. And this is a big reason why the current Chinese administration has pushed this theme of common prosperity. The reality is that this wide wealth and income inequality that's opened up is a fundamental threat to the political legitimacy of the government. And so they are very concerned to deal with this. Geopolitical conflict with the United States. I put the chart or the map on the left-hand side of the page here, not to be provocative, but to put things into context. That there's a huge narrative in the West about China being an aggressor nation or a belligerent nation. But actually, if you look at China, it is absolutely surrounded by US military bases in the East China Sea and the South China Sea. Most of us think about China as a major exporter, but the reality is that China is a re-exporter. It has to import many of the original commodities that go into its manufacturing exports. And most importantly, China is not self-sufficient for energy or food. Those imports come by sea through the Straits of Malacca, over which the US Navy has a chokehold. This is a significant point of vulnerability that the Chinese government has been keen to deal with. And one of the ways it's dealt with that, or been trying to deal with it, is by diversifying its sources of supply, mainly across the Siberian border from Russia, from which it's importing more grain and it's importing more oil. If you look at China's response to the Ukraine crisis right now and its unwillingness to follow Western sanctions, you will understand from this that its growing dependence on Russia makes it very, very difficult to do so. But China is not just surrounded in terms of its military encirclement by the United States, and it's not just surrounded in the China Sea. China continues to be very dependent on the US dollar in its financial interactions with the rest of the world. This is another consequence of the failure to develop its domestic capital markets and to internationalize its currency. This means that China is very, very susceptible to US financial sanctions or Western financial sanctions. And if you think about this in the context of China deploying its savings, that $35 trillion in bank deposits clearly needs to find its way into capital markets to generate better returns. China's domestic capital markets, large as they are not big enough or deep enough to absorb those in any short space of time, not at least without generating huge asset price bubbles. But China, if it wants to invest that money overseas, in overseas equity and debt markets, it finds itself entirely dependent on a Western-controlled financial infrastructure. This includes payment networks such as SWIFT, but also international depositories such as Euroclear based in Belgium, Clearstream based in Luxembourg, and a group of US global custodian banks. And Chinese policymakers have quite simply looked at the means of affecting financial sanctions on Russia since 2014 and thrown their hands up and said, look, we'd like to be able to invest outside, but we cannot possibly put ourselves at this financial security risk. So what we've ended up with is a horrible stalemate where actually it would be entirely in China's interest to allow some of this portfolio flow to come out into international markets. It would certainly be in the West's interest to receive some of that Chinese investment. This is the largest untapped capital pool in the world. Think about all of the infrastructure improvement and development and R&D that could be funded if Western corporations were able to tap into that source of capital. But with the lack of a secure means of allowing Chinese investors to come out, that capital is not available to the rest of the world. And when you look at this, it also creates other problems, because China, unable to pursue those portfolio capital flows, has generally then invested in other countries trying to improve its returns through corporations and particularly state-owned enterprises, most notably through the Belt and Road Initiative. Inevitably, this leads to significant frictions and conflicts or sensitivities about the level of Chinese government influence, control over major assets or corporations in other countries. There's questions over technology transfer, there's questions over job transfer. If you had 1,000 Mrs. Wangs from Chongqing buying a few shares of Amazon or Microsoft, nobody's going to care. So this is something which I think that both countries need to look very hard at to find a secure financial commons for them to invest in. So I'll end this presentation by asking answering how should policymakers respond? Well, first of all, I think we need to recognize that ultimately what we need to do is to make financial markets work better, to better distribute the fruits of economic growth and prosperity in order to help de-escalate some of the domestic social tensions that have bubbled up in China, America, and elsewhere. But decoupling, which has been touted, really is not the answer. Decoupling would only make both countries and a lot of other countries poorer and most likely exacerbate many of the social tensions that already exist today. Instead, China and America, given the level to which their economies are intertwined and interconnected through the channels of international trade and investment, need to recognize that each of them has a very strong interest in each other's social and economic well-being. Both countries pursue a different balance of markets and state, but ultimately both countries need to find a better balance in the role of markets, between the role of markets and the state. Both countries need to look at the incentive structures that exist in their public spheres and in their private spheres to remove some of the perverse incentives that exist. And the dollar-based global monetary system needs significant reform. I'm not going to go into how that might be done here today, but chapter 8 of my book looks at some suggestions about how the US and China and other countries may cooperate to go about doing that. Then finally, given the butterfly effects of financial markets and the level to which global or globalization has interconnected us, we've got to recognize that changes in financial policies or industrial policies in one country can have huge disproportionate impacts in other countries. And so as we reform the system, we need to ensure that there is sufficient cooperation and coordination over international financial, industrial, and fiscal policies in order to ensure or control the fallout from them. As one last thing in this presentation, since I'm from Hong Kong, I will point out that Hong Kong has played an extremely vital role in intermediating trade and investment between China and the West. Through the Stock Connect and Bond Connect scheme set up by the Hong Kong Exchange, 70% of all international investors' holdings of Chinese onshore equities are held and custodied through Hong Kong. 53% of all international investors' holdings of Chinese domestic bonds are held through Hong Kong. They come through Hong Kong largely because Hong Kong offers them a greater degree of regulatory and legal protection and property right protections than they feel they might otherwise get by going directly onshore. Perhaps Hong Kong could also be used as a gateway through which Chinese capital or Chinese portfolio flows can find its way into international markets in a safe and secure and sanctions-proof way. But a lot of work needs to be done. Hong Kong has been through some very turbulent times recently, and it needs to reestablish itself and regain a significant amount of trust from its key constituents. Let's hope it is able to do this. Thank you all.
Thank you very much, James, for this really excellent and succinct and clear summary of your book. It gives us a lot of food for thought. I imagine some of our audience will rush out to buy the book. Before I turn to the Q&A session, I realized I should introduce myself at the beginning of the event, which I forgot to do. So my name is Shang-Jin. I'm a professor, NT Wang Professor of Chinese Economy and Business at the Columbia Business School and School of International Public Affairs, and Professor of Finance and Economics. So it's my privilege to moderate this and already learned a lot from James' summary of the book. To start off the Q&A session, let me invite Professor Andy Nathan, please.
Thank you, Shang-Jin. I want to remind the people who are listening that you can put questions in the Q&A tab at the bottom of your screen. So James, before we started, I told James I'm not a finance guy, political science, but you have a great talent of explaining finance in a way that gets across even to people who don't understand finance. So thank you for that. I look forward to reading the book. I want to ask, my first question is, at the beginning of your presentation, you described a conversation you had with an interlocutor in China, and you realized that it wasn't that he didn't understand Western finance, but that he had a different idea. So I want to ask whether he agrees with what you said on slide 11, which is, as I understood it, that capital markets allocate investment more efficiently than the state does. Does he agree with that?
You'll have to ask it. You'll have to ask him. I would suspect that since he works for the Shanghai Stock Exchange, I would suspect that he would tend to agree with that statement. But I think that there's a huge. I think that there's a huge kind of ideological blocker that's built up in many parts of the world, and particularly in the West and the United States, over the role of markets. That there's this narrative that markets are perfectly efficient without any intervention by government, and that simply is not the case. I mean, when you think about capitalism, capitalist systems and markets, they ultimately allocate resources not based on any form of merit, but based on the ability to pay. In any capitalist system, as you understand, capital compounds, wealth compounds. I think Einstein was reputed to have said that compounding was the eighth wonder of the world. The fact is that over time, when you have unfettered markets and free market laissez-faire capitalism, the wealth tends to concentrate amongst a few, and those few are able to use their wealth to influence policy to favor themselves and to maintain their positions in society and in the economy. And so to some extent, the state needs to provide some counterbalance to that. One of the big forms of counterbalance is through education, and particularly granting better access to education to help people be able to move through the social classes through education, hard work, and merit. So I think that China and the United States have different points of view on this. China would err towards greater state intervention, that the US would err towards less state intervention. I don't think either side have gotten the mix entirely right as of this time, and I think both have quite a good deal to learn from each other.
But I understood your argument to be that a lot of China's problems have to do with the lack of maturity of their capital markets. And so I guess what I'm asking with my little question is, what's the obstacle to their creating more efficient capital markets? Is the United States the obstacle? Is it their fear of private entrepreneurs having a lot of influence? Or is it their ideological belief, and this is what I'm suggesting, that they know better how to invest money because they have the national interest in mind and the private entrepreneurs are merely selfish? So is it ideology that prevents them from creating more open markets? I understand that the market is never a pure market and the state is never a pure state, but you were the one who said their financial markets are underdeveloped. So what is the reason for this?
That's a good question, and I think all of the factors that you mentioned play a part. The government, clearly through control of its financial markets and control of the ability to allocate and price capital, it's a major source of power for the Chinese government, and it's a source of power that the Chinese government has been quite reluctant to give up. In fact, it's not only a source of power domestically, it's a source of power internationally, because access to China's markets has been a significant inducement, and China has been able to use the threat of denial of access to its markets in order to coerce other countries into aligning with China's diplomatic or other interests. So that certainly is one factor. But on top of that, you've also got to look at the recent history and the context out of which Chinese leaders have come to frame their view of the world and their view of capital markets. During the Asian financial crisis, countries around Asia were not significantly over-levered. They didn't have dangerously high levels of public or other debt, but their companies and their governments quite often had to borrow in US dollars. And when there was a collapse in the value of their currencies versus the US dollars, this made it very difficult for them to repay. This led to huge job losses, it led to bankruptcies, it led to a huge amount of economic misery in those countries. And actually, China largely skirted around that because it hadn't yet at that point seriously embarked on the development of its capital markets, and so managed to dodge a bullet. And the lesson that Chinese policymakers took away from that was a wariness of reliance on foreign debt, and also a wariness of allowing foreign speculators to play a significant role in their financial markets, because when that money that comes in to the country gets withdrawn very quickly, that can be both economically very destabilizing and socially very destabilizing. The fact is also, the other factor you mentioned was that the United States. The fact is also that it's been very easy to rely, given the role of the dollar, and although it's called an exorbitant privilege, and a lot of people think of that as something in favor of the US at the expense of everyone else. The reality is that the US bears a massive cost to its society by allowing its currency to play in that international role. And Chinese policymakers have been quite wary about allowing their currency to step in and serve in that role, simply because the loss of the ability to adjust to economic realities or changes in productivity levels versus other economies could have huge consequences for China's export sector, on which jobs are still very dependent. So all of those factors that you mentioned are at play.
Can I follow up on this point, James? Maybe challenge you a little bit to get your ideas out. What you describe about underdevelopment of financial market is not entirely policymakers' choices. Like Chinese starting point is a highly centralized, state-dominated system. So whatever we see, whatever imperfection we see, it's already a lot. I'm talking about financial system here, substantially more market-oriented than its starting point. That's one. And two, it's not that unique, right? So the developing countries generally have underdeveloped, imperfect financial market characterized by many state-owned financial institutions. India next door, a country with almost the same population size, has the state-owned banks is a bigger share of Indian financial market than Chinese state-owned banks. So that's sort of one observation. I wonder whether you agree with that. The other is the further development of Chinese market, including opening up financial market. I want to put the opposite hypothesis to you, see what you say. Could potentially exacerbate conflict rather than alleviate conflict with the US. So let me suggest two ways. So imagine China get rid of capital controls. Like you said, a bigger portion of Chinese savings will now have a chance to be invested abroad. A necessary consequence of this is that China will run an even bigger current account surplus and trade surplus, including potentially increasing trade surplus with the US. And there will be a source of conflict rather than a source of comfort for the US. And then more efficient allocation of capital within the country may be good for China. It will give you a faster growth of China, a bigger Chinese economy. I noticed that your book referenced to this trap from Graham Allison. If the latecomers become even bigger and growing faster, it's not obvious that this will help with the conflict. It could potentially exacerbate the conflict. So there can be mechanisms that will suggest that the improvement in Chinese domestic market, liberalization of the capital account, could contribute to more conflict rather than less conflict. I'm sure I'm wrong, so I just want to hear your views on this.
Well, Shang-Jin, I think your first point I wholeheartedly agree with, which is that China's capital markets have come an awfully long way. I think that that there are practical reasons for China to pursue capital markets internationalization and opening it in a very measured way, not least because if you think about potentially $35 trillion sitting in bank deposits in China suddenly hitting international capital markets all at once, or even going into the US markets, it would drive massive asset price bubbles potentially in the recipient countries. And we've seen that, we saw that in 2007 when they announced the through train program to Hong Kong. The Hang Seng Index shot up, and then
we see in Vancouver and Sydney as well, right? So the governments there trying to limit capital inflow from China and Hong Kong also, I guess.
Yeah, there's a huge amount of savings in China which have hit international markets, and the property sector, I think, is that you cite is a very apt example. From Vancouver to Sydney, you've seen the effect of Chinese money coming into those markets, causing a huge amount of conflicts and tensions there. But I think that there also I think certain ideological, going back to Andy's comment of ideology, I think there's certain ideological factors at play, which are that, although the Chinese government has pursued a liberalization of markets, it kind of constantly goes 2 steps forwards and then jumps back 1 step. It never wants to give up control. And you look through Chinese history, and this dates back even to the Song dynasty, that there was a very clear separation between private enterprise and the state. And Chinese policymakers, not just the current administration or under the Communist Party's leadership, Chinese administrations or dynasties have consistently been quite wary about giving markets or giving private businessmen outsized influence in the role of the state. And that I think is one of the key points of difference, and one of the key issues that the current Chinese government cite about the US or Western system is that it's kind of allowed private interests and wealthy interests to run amok. And when you look at the control and monopoly power which is exerted by the internet platforms in the United States, which have not yet been dealt with, versus China's move, however much you might criticize the lack of due process involved in that, China has moved very swiftly to address some of the monopoly abuses by its major internet platform providers. So that is a key point of ideological difference. I believe, and I'm hopeful, that China will continue to reform its financial markets, and that they will continue to gradually open up and liberalize. Will they liberalize to the extent that they are liberalized in the United States today at any one point? I don't know. I have a certain degree of skepticism about that.
To our other audience, as Professor Nathan mentioned, you're welcome to submit your question either in the Q&A part, or you can write it in the chat room. Andy,
I don't
come
think
back to you? Yeah.
I'm not sure that the listeners can access the chat. I'm not sure.
Oh, I see. Okay.
Okay, let me ask the following question. I really was informed by your account of why it's not in the interest of the United States, or in my interest as a sort of middle-class person, for the US to bear the burden of dollarizing the international system, providing all of these dollars for everybody else to do business. It's not really in our interest. So let's say I get on the train and go down to Washington, D.C. to persuade my congressman, we got to get rid of this thing. There'll be two questions. One is, with what will we replace the dollar? Not the renminbi. We don't want to do that. Maybe you're going to say the SDRs or something. So let's say I'd like to know your answer, but I get over that hurdle. And then my senator says to me, I'm not giving it up, because although we pay a certain price for it, it has tremendous advantages. Number one, we can sanction other people. Number two, we can live off the labor of other people and raise our living standard. How do I answer him?
Just sorry, James, add one question. Maybe Andy got it. I may have forgotten. Can you remind me what are the costs to the US for the dollar-centered international system?
Well, it requires the US to go into higher and higher levels of debt, which create fragility in the financial markets, which have been contributing these.
Are you talking about Chiffon's dilemma? I see.
Well, it's resulted in the ever more frequent occurrence, ever more violent occurrence of financial crises. It has also structurally overvalued the dollar, and so exacerbated the loss of economic competitiveness or export competitiveness, costing US workers their jobs and contributing to the rise in inequality that you've seen in the US.
I see. I thought that's not a problem under flexible exchange regimes. It might be a problem under Bretton Woods system, where you have a fixed exchange rate, and that's incompatible with a rise current account deficit of the US. But under flexible exchange rate, the regime, that's Triffin's dilemma is less important.
Well, I mean, do you really have a fully flexible exchange rate regime? The fact is that international demand for US dollars, particularly it's less so in trade, actually, particularly in financial markets, has really contributed to that overvaluation of the dollar, because people buy US treasuries because they're a risk-free asset they're able to use to collateralize their derivatives trading, margin trading, etc. It's the default go-to currency, and that there's significant network effects which kind of enhance that role, not least that the US dollar's role in being the currency in which many commodity contracts are denominated. And so hence, the interest rates and other hedging that tie to that commodity trading ultimately comes into US dollar. It creates a huge amount of demand that wouldn't otherwise be there. So, but to go back to Andy's questions, reform of the dollar system would be extremely difficult indeed, and it is not an undertaking to be pursued lightly, and it is not one that can be achieved within a short space of years. It would take decades, and it would take a huge amount of coordination between other countries. There are broadly kind of three paths that I think you could pursue that I talk about in the book. There may be others. The first, as you suggest, is a greater use of a neutral currency. If you actually look back to the Bretton Woods discussions, that the dollar was only one of two options on the table. That the British proposal put forward by the economist John Maynard Keynes was to create a international currency unit called the Bancor, which I think actually in retrospect may have been the better option. The IMF SDRs, which I guess are the sort of successor to that, could play that role, and that's what the Chinese have been pushing since Zhou Xiaochuan, the former PBOC governor, gave his speech in 2009 advocating them. And I think that's certainly something that would be worth trying to pursue, although the SDRs are effectively a reserve asset. They're not actually it's not a traded currency. It's not a commonly used currency. There are no assets that are priced in SDRs. There are no derivative contracts that are priced in SDRs, etc. And that there would be a huge amount of work to make those replace the US dollar. And you'd also have to start creating effectively SDR denominated risk-free assets that could replace or supplant the role of US treasuries in financial markets. It would be a very difficult thing to do. The other option, which may actually result by default, is a more balanced currency regime in which a handful of currencies come to occupy fairly similar status as each other. The problem with that system is that that there are significant scale efficiencies in using a single currency unit to price commodities, to price hedging contracts and interest, FX rates, and so forth, which would be lost. And what you might find if you went to a more balanced currency basket is that global trade and investment may become siloed within currency blocks, which would inevitably lead to a loss of the scale benefits and specialization of globalization, and likely make us all the worse off. But in the current atmosphere, it seems unlikely that countries will be able to come together to cooperate and coordinate to create a common international currency unit. And what you may find is that, you know, as the renminbi's international usage grows, it may come to not necessarily rival the dollar, but to occupy a significantly greater role. And maybe China and Russia go off and trade in renminbi with each other and do less trade with the Western world that goes off and trades in US dollars or euros or whatever they do. The third option, probably controversially, would be to recognize that the dollar's utility value and to actually provide the US some compensation for providing that utility to the world. I'm not saying that, you know, that the rest of the world should be helping fund, you know, US kind of warmongering in places like Iraq, you know, where it racked up trillions of dollars in national debt. But I think that, you know, certainly other countries might consider that the US dollar's utility role is something that's worth compensating the US dollar for. And, you know, that there would be some sort of adjustment to recognize that. Now, I see that as being politically very difficult, because, you know, the idea of paying another country to run balance of payments deficits, I think, would be politically very difficult to swallow for most electorates and most governments even. But it is a possible avenue for consideration. So Andy, your other question was around, you know, why should the US do it? Because it would lose financial sanctions. Well, I think that there's several reasons to do it. You know, if you don't believe that, you know, helping to give US true currency flexibility to help restore competitiveness, restore US jobs, and restore US economic vibrancy is not a sufficient reason to do it, then I would offer you this, which is that, you know, ultimately all currencies are simply, you know, it's a method of transacting. I mean, we use US dollars today, but, you know, in the past you've used gold, you know, you've used seashells. You know, some societies have used seashells. I mean, there's any currency system is ultimately dependent on trust and society's belief in it. And, you know, we've gone a very long way of debauching the US public balance sheet without hitting a tipping point. You know, although, you know, I think we perhaps came close in March 2020 in the fallout of the US Treasury market. The problem is that when that trust or belief is lost, you could see a very catastrophic and violent rebalancing of the currency system. What's more is that if it is done in a disorderly way and another country's currency rises to usurp the US dollar, and the financial infrastructure that supports that other currency rises to supplant the Western controlled international financial infrastructure that exists today, that would cause the transfer of a huge amount of power to the parties that controlled that new reserve currency and that new financial infrastructure. And, you know, while other countries have been very wary of US abuses of its control over the dollar system and the financial infrastructure supporting that, I would suggest that the US should think about, well, what if the shoe were on the other foot, and say China or Russia or India were to control that global reserve currency and that global financial infrastructure and have the power that the US enjoys and which has used and significantly abused to today. I would say that it's probably in the US, if you're pursuing a policy of enlightened self-interest, the opportunity at this point in time to create a neutral unit with a neutral financial, international or global financial commons might be quite attractive.
If I could follow up on this, James, on this argument that the U.S. should practice self-restraint because if the world is in the other foot, as you said, perhaps U.S. will find itself disadvantaged if China, India, some other countries have this. But the counter argument will be, if we ever move to a world in which dollar becomes much less important, we are long away from that. But if it happens, it's hard to imagine that China can be restrained not to exercise their whatever privilege they may have in global financial system, and therefore, as long as we meaning the U.S. still have the privilege, why not use it? I guess you say there will be the argument for moving away from any of the national currency being a dominant one. I guess the potential reservation of the counter argument to that is that it's very hard to imagine a supranational unit to be to play the same role as dollar. I mean, the banker, either banker or SDR cannot do the same thing. SDR is just an accounting unit. It's just mechanically a weighted average of 4 or 5 leading currencies. The dollar is important because people think U.S. financial markets deep, a U.S. monetary system by and large is responsible. It will not artificially generate inflation, and these properties are not shared by some artificial currency. If we cannot go to the artificial currency, even if someday dollar will be supplanted by some other currency, it will not by itself necessarily say U.S. should practice self-restraint. So I just want to put out those potential counter arguments for you to knock down.
Well, the history of reserve currencies in the U.S. is by no means the first. Is that governments have tended over time to debauch their currencies, and they tend to have been supplanted and replaced by others. The U.S. dollar replaced the sterling system, which in turn replaced the Dutch guilder as the international currency unit. And so over history, it's almost inevitable that a currency will rise and fall. And while you say that the US has pursued responsible financial policies, I would respectfully disagree in that that the US public balance sheet has since the 1970s been significant debauch, and in fact over the last 2 and a bit years during the course of the pandemic, you've had a 40% increase in the US dollar supply. This, at some point, if you look back through the history of financial markets and the history of reserve currencies, it inevitably is going to end in tears. That the US dollar is very, very powerfully entrenched and much more entrenched than its predecessors because of the level of globalization that we have today and the huge amount of infrastructure that has built up around the US dollar. But I would not be lulled into a sense of complacency around the ability for the US dollar to lose that status.
Can I ask about, to go back to your argument that both China and the United States are suffering from some severe economic dysfunctions, and the chief common economic dysfunction is widening inequality, if I followed you. And you gave reasons that were internal to the US, such as the lack of antitrust enforcement, the over issue of the dollar and so forth for the US trouble, and reasons that were internal to the Chinese system, such as the demographic changes and state control for the Chinese problem. But I was wondering whether I missed a part of your argument in which you felt that the interaction between the two economies was causing trouble for each of them. Is that a dynamic that's part of your argument?
Yeah, yes, it is. And sorry if I didn't make that clear during the presentation. The fact is that, I mean, there are huge interlinkages between the markets now. And so take, fiscal policy for one reason. If one country lowers its taxation in order to lowers its rate of taxation and to draw investment towards itself, it's inherently taking away investment from another country. And so it's led to this kind of cascade of, or race to the bottom in terms of tax rates, which has been a contributor. You can talk about monopoly enforcement. I mean, many of the arguments that were used in the 1980s against antitrust enforcement was a fear of the Japanese conglomerates or major Japanese corporations competing, that had scale, that competed against the US. I don't necessarily agree with those arguments, and I think that there's significant evidence to show that they're just simply not true. But I think certainly when you've got large kind of state-backed national champions going out and competing in other markets, whether it's in Africa or Europe or around Asia, against US enterprises, it becomes less easy for policymakers to pursue the sort of breakups because they don't want to put their corporations at a disadvantage.
I guess another interaction is that one way U.S. companies in negotiating with workers for wages was one reason they cite that we cannot raise your wage too much is because the jobs will go to China, Mexico, some other countries. Either the company can threaten to take the factories abroad, or from China, in the latest round, or they just say the competition is such that we cannot afford to raise wages. So that's, I guess, one source of another source of interaction.
Yeah.
Can I shift to the question that everybody asks in my field of political science? Will China crash economically? This is, I think, not within the bounds of your particular argument today, but it's something when we have a finance person who's an expert on China, we want to ask, is the Chinese system going to crash?
It is impossible to predict, and my experience in financial markets suggests it would be foolhardy to have a very firm view on this. But I would say that I was an exchange student in Japan in 1996. And at that time, my parents gave me a very generous allowance. But even with that generous allowance, I realized that Japan at the time was so expensive that if I wanted to keep some money in my pocket to go for a few beers at the weekend, I could afford to eat one meal a day. So in fact, I would go to this Ukrainian restaurant every lunchtime, not necessarily because the food was good, but because they offered large portions and it was stodgy and I could fill myself up. And hence, I had my money for the weekends. If you recall back to the 1980s, there was a point at which the Imperial Palace grounds in Tokyo, that square in central Tokyo, was valued at more than all of the land in California. I still go up to Japan very regularly, and I can tell you now that it is transformed massively. Tokyo is one of the most affordable top-tier cities in the world to visit. And in fact, if you go to some parts of rural Japan, they can't even give away the houses there. That is the impact of demographic decline on Japan. And the fact is that because of the one-child policy, China is aging at 3 times the rate of Japan and the West. It has huge economic impacts. It has huge societal impacts, this aging process. And I think that, this is why I put it first on the list. This is the biggest challenge that China faces today. It's managed to grow on the back of a huge labor force and being able to harness their savings. But when that goes into demographic decline, it will inevitably drag on the economy. It's a problem that China's government will have to manage in the same way as many other governments around the world have to manage. Whether that leads to a crash, I don't know, because actually, if you go to Japan today, if that's the product of 30 years of economic stagnation, then I would willingly vote for more of it, because actually Japan has a very high quality of life. It's a prosperous society. In fact, they've got a developed infrastructure. In fact, as the population has declined, on average, people have been better off. It's a little bit less crowded on the trains than it was. It's a little bit more affordable for young people to buy houses. And the quality of life is very, very good. And so in some senses, China might be able to manage this transition in quite a benign manner, but it's not certain, and it's certainly not going to be easy.
Well, the crash of Chinese economy has been predicted a few times in the last 20 years. On demographics, James, the Chinese government has rolled out a few policies to try to boost birth rates, various modifications of family planning policy. We don't really see a big rebound in the birth data yet, but some say partly because people have already mentally adjusted to the old policy. They have convinced themselves that one child is the best number, is the right number to have. Now, just with the new policy, one might need to give some time for the family to adjust to the new norm. I didn't have people say, look at Hong Kong, look at Taiwan, look at Singapore, look at Europe, where there's no strict family planning policy, and still people, you have a declining birth rates. Do you have a view on whether any family planning policy reforms or incentives for childbirth can reverse this demographic change?
I think that's very difficult. In fact, last year, China hit a record low in terms of its fertility rate. It was 1.3 children per woman, which compares with, is record low, and it's on the back of huge attempts to boost the population. And that compares with a replacement rate population or fertility rate of 2.1. The fact is, you've seen all over the world that modern lifestyles, particularly urban living, female education, female participation in the workforce, has tended to lead to a decline in the birth rate. Again, I don't necessarily think that's ultimately a bad thing. I think it's bad as you go through the transition period, because our whole societies have developed in the last 100 years on the basis of increasing GDP, which requires effectively increasing consumption, which assumes ever increasing population. I mean, in some ways, that's a completely illogical. It's a completely illogical measure of people's financial and other forms of well-being. If you look back to the Chinese dynastic cycles, Mencius over 2,000 years ago, tracked the rises and falls in Chinese dynasties to the ratio of arable land per head of population. It's quite logical in agrarian societies, as China was in those days, that if you have more people and that there's a relatively fixed supply of land, there's going to be at some point, as the population goes up, less to go around. It's going to cause social tensions and frictions. And this, if you track it, has tended to coincide with rebellions or invasions that have overturned dynasties. In some instances, millions of people died, and you effectively had a rebound in the amount of arable land per head of population. And then, through you have a reset, and through the peace, you have a regrowth in the population, and the cycle continues. So I say that I give you that example for two reasons. The first being that actually, if you think, the financial system and financial markets as they exist today are an abstract. If you look through to the fundamentals, that the reality is actually having a smaller population overall actually means that there's more resources to go around, and financial markets are ultimately a means of allocating resources. The second reason why I cite that example is because today we have, through the communications and access to information that we all have today, we have an unprecedented ability to access information on and understand prior historical cycles. What we're seeing today in terms of tensions in the United States and tension in China, tension between the two countries, follow a historic pattern. And if you follow that historic pattern through to its conclusion, it gets us to not a very good place. But given the information that we have access to today, we should, or our leaders should, be able to understand what's happening and devise policies and strategies to help us repeating, or help us avoid repeating those historical mistakes that have afflicted societies before ours.
James, can I bring you back to the Hong Kong China Stock Connect example that you started the talk with? Now, since you are one of the key persons in making this to happen. Now 5 or 6 have passed. Looking back, has this been a significant financial opening or reform experiment done by China and by Hong Kong? And going forward, should we expect to see more financial liberalization, financial opening measures taken by China, or do we expect to see a reversal of policies?
So it has been unbelievably successful. Now, I think it's been unbelievably successful on several measures, and this is notwithstanding everything that we and myself got wrong in the process of implementation that could have screwed it up. The fact is that it has drawn in hundreds of billions of dollars of foreign investment into Chinese capital markets. It's also drawn many hundreds of billions of dollars of investment from China out into Hong Kong. This has been great it's been great in terms of offering diverse access to investment, diversity of investment products, etc., for investors on both sides. It's also helped internationalize China's capital markets by enabling international index companies to include Chinese securities into major benchmark indices, which has given international investors access or exposure to China's enormous growth and potential, and it's drawn investment into China. And in the process of doing that, it's helped improve and help the process of maturation of the domestic capital markets. So in all senses, I think it has been a huge success. The initial Connect scheme was very easy to implement because it was entirely reciprocal. So, effectively, money came into China through Hong Kong, money was coming out into Hong Kong, through our link with Shanghai. It's perhaps stalled a little bit in terms of further widening the range of investment products to ETFs and allowing investors to invest in primary IPOs, largely because of differences in commercial interests between the organization. Because if I think we've gotten to a stage where incremental opening would come at or one or other exchange would feel that it comes at a cost to its own commercial interests, which is why we've seen less innovations happening in the last few years. I think that's perhaps regrettable because, in fact, I think it's in both China and the international community's interest to see a greater interaction through a wider range of products. It doesn't necessarily follow that it all has to come through Hong Kong, but international investors have tended to see Hong Kong as providing a greater level of legal and regulatory protections, and particularly property right protections. 70% of all international investment in China's domestic stock markets comes through the Stock Connect scheme. This is because international investors trust in the Hong Kong system. And Hong Kong obviously has gone through quite a lot in the last few years, and perhaps some of that trust has been undermined. I think that would be very regrettable, both for international investors and for China itself, because the reality is that some of that money might be willing to go directly onshore to China, but from personal interaction with many of the large institutional investors, and particularly the sovereign wealth funds and so forth, the fact of having the Hong Kong wrapper has been key to encouraging them to put money into China. So if Hong Kong were to be taken out of the equation and those investors were forced to go directly, some of the money and some of that investment may not come at all. In fact, I believe a significant swathe of that money and investment wouldn't come at all. And so I think it's critical that, notwithstanding everything that's occurred in the last few years, both the mainland government in the West, broadly represented by the US and the US government, have a very strong interest in making Hong Kong work and allowing it to continue to play in that role. And hopefully both sides will avoid the temptation of using Hong Kong as a geopolitical football in the tensions or competition that exists between them, and allow it to serve in the role that has benefited them both so much.
All right, on this note, let me thank everyone for participating in today's event, especially James Falk. His new book is Financial Cold War. Thank you very much. This concludes today's event.
Thank you, Shang-Jin, and thank you very much, Andy.
Thank you.
Bye-bye.
Bye.